Good afternoon. Wonderful to see a good crowd here. No surprise, given our esteemed guest. I always like asking this, and the interesting thing is the hands continue to decline because this isn't the first time for many of you. But for how many of you is this your first time at a Jonathan M. Nelson Center event? Yeah, a few of you, which is great. And it's always good to have new people join us. I'm Danny Warshay. I'm the executive director of the Jonathan M. Nelson Center for Entrepreneurship. Really happy to be here and really happy to have you all here. I always like to take 30 seconds as an opportunity to, especially for the new folks, to welcome you and to tell you that we are doing everything related to entrepreneurship on and even beyond this campus. In the curriculum, so you know that we, in fact myself, I teach a course related to entrepreneurship called the Entrepreneurial Process that we have every semester. We have other courses. We do academic research. We led an academic research conference last semester called Entrepreneurship at the Intersection of Diversity and Inequality. We had world-class researchers from all over the country convene here at Brown, focused on those really important topics. And most of them said it was the first time that anybody had ever convened such an academic research conference. And I was really proud that Brown did it, and even more proud that our center, even if in its infancy, 90 days in, was crazy enough to convene a group of researchers. We had 160 people there, and it's spawned all sorts of other academic research activity in colloquia, in publishing that we're going to be doing, in if there are any grad students here, we're sponsoring graduate students to do ongoing research on those topics this summer. So if you haven't heard about that, let us know and we'll be happy to tell you about that. So I underscore that first because this is a university. Everything we do has to have academic rigor. It may not be in the classroom, but it's not just a club. It's a university-based initiative. The second is, like this, lots of co-curricular activities, because lots of learning, and Larry and I are aligned on this, happens beyond the classroom in the form of these kinds of workshops, speakers, events. We just had 3 of them alone this week, and I see familiar faces from those. We'll be doing a lot more through the end of the year. We're sprinting through the finish line, and that's, I think, a lot of what we're known for. And we also provide resources for venture support in the form of increasing amounts of grants. We run a summer accelerator. We provide mentorship from academics, non-academics, people in and outside the classroom, experienced entrepreneurs who are eager through our alumni base to share what they've learned about their achievements and even their mistakes with our students. And we are conducting office hours and matchmaking people with those kinds of resources throughout the entire Brown ecosystem. So that's my little somewhat self-serving Nelson Center announcement. We really hope you'll join us not just today, but at all the events we are doing. If you're not on our mailing list, although I suspect you are because of your attendance today, but if you're not, you can email us or even just email us in general if you have questions, comments, inquiries at entrepreneurship@brown.edu. And if you're curious to go to our website is entrepreneurship.brown.edu. So entrepreneurship@brown.edu to email us, entrepreneurship.brown.edu to find out what we're up to. I'm really excited to introduce Larry Rand, and I'm going to let Larry tell you a little bit more woven through his interaction with you about what he's been up to. But Larry and I met early last fall when we were just getting started. And I felt like we really hit it off on the same wavelength about what our vision should be and how we should attend to providing value to all of you, to our ecosystem throughout Brown, mostly our students, but also faculty and staff and parents and alumni. And Larry, without hesitating, said, call on me whenever you want. I'm eager to get involved, and it could be in the classroom, out of the classroom, and I said, you're on, and we envisioned this. So I'm really happy we're moving forward. Larry is a proud graduate of this institution. He celebrated his graduation, he tells me, marked by the bicentennial celebration of Brown University. I'll let you all figure out what year that was. And if you're stumped, as some of you have a ring that marks the founding of Brown, you can check what that number is. He also has a master's degree and a PhD from New York University. and has been an active teacher in the classroom, including here at Brown. And many really enthusiastic students have raved about him. And then he has spent most of his career doing the thing that I know many of you are interested in or are doing already, and that is entrepreneurship. And so Larry is eminently qualified by virtue of his own academic learning and his research and his teaching, and maybe for more of what you're interested in by virtue of his own taking steps toward being an entrepreneur in the field of communications and governance issues, advocating for and advising some of the biggest and most well-known companies and their executives that you're very well familiar with. That's a topic that I'm gratified has attracted all of you here. Honestly, when we tried to formulate, thinking about even communication and PR, I wasn't sure how we should frame this in a way that would be compelling, and yet you're all sophisticated enough to know this issue of governance and communication is really critical, maybe in some ways especially at the stages at which you all are in your own ventures or are anticipating. And some of you I know aren't familiar with those topics at all, but are sophisticated enough that it's really important to become grounded in them. So I'm going to introduce Larry. This is going to be very interactive, so by all means, feel comfortable to ask questions, make comments, and let's welcome Larry to Brown.
This is not a lecture, this is a give and take, and I expect and hope that you will give and take. There's also a little hook here. The promo was a little more flowery than should be said, and I'll take full credit and blame for that. We also have a free lunch, and that always brings out a crowd. But there is also an important typo in that promo. It's not John Vogel, it's John Bogle. And for those people who don't know, and he's in his 90s now, he's still active, is investing, and he formed the Vanguard Group and is one of the great investors of all times, and friendly with people of his own generation, including guys like Warren Buffett. So if you look at that little promo that we put together, it really comes down to understanding in this day and age, what is corporate governance, or governance at all, and why, as budding entrepreneurs, should you be interested in it? And I'm going to talk a little bit circuitously around that, but it's going to come back to the theme of governance and entrepreneurship, because a lot of that relates, although budding entrepreneurs never think that governance is important to them, and that's fine with me. I put on the whiteboard here what corporate governance is according to a specialist, and let me read it because my handwriting sucks. It says corporate governance is about promises. It's a set of legal and economic devices that induce the people in charge of companies to keep promises they make to investors. That goes across virtually everything. It could go from General Motors to General Dynamics to lieutenant entrepreneur. I don't care if it's a general or not anymore. But the fact is, that was written by a Yale professor, Jonathan R. Macy, and out of his book on corporate governance, promises kept, promises not kept. So going by the Macy theory, the question is, right there, who are the people in charge? When you look at a company, when you look at an institution, who's in charge? Anybody? Give me an answer. Tell me anything. Who's in charge? Yeah.
The board.
Good answer. The board. Anybody else in charge?
CEO.
CEO? Well, okay, so that's management. And the board. Now, who makes up the board? And what's the role of a board? Okay, what's happened in corporate America over the last several years is that investors, who is also in charge, by the way, because they have the stake in the company, that the management is charged or tasked with operating the company. That means that they have to have a plan, a strategic plan to operate and execute against that strategic plan. If they are successful in developing a good strategic plan and executing against it, one would think that they are going to create value. Remember those two words, create value, because either as an entrepreneur or the CEO of General Motors, if you're Mary Barra, your job is to create value for the shareholders, okay, the investors. What's the role of the board? Well, the board has a very interesting role because throughout the recent history, but not the most recent history, it was assumed that the board is there to rubber stamp management. If that's the role of the board, they are derelict in their duty. They are if you're the shareholders, they are your representatives. They should be independent, and they should be tasked with three main objectives. The first objective is to approve or disapprove or somehow talk to management about the validity of the strategic plan. In other words, will we, if we follow this strategic plan, create value for our investors? Their second major role is to provide oversight. If management is not creating value for the investors, either because the strategic plan is wrong or because they're not executing well against it, their role is to get rid of management. And the third, and probably the place where most boards fail, is that what is the plan of succession in management? I promise you that is the least important thing in their minds, but it's probably the most important thing that a director should do. And all I have to do is tell you, everybody in this room, I'm willing to bet, has an Apple device. Does anybody not have an Apple device? Whoa, okay, we have some heretics in the room. The worst thing that Steve Jobs did was he never allowed his board to talk about succession. He believed that he could live forever. Well, he was wrong. And he did a disservice to the investors, and the board did a disservice to the investors by never compelling him to come up with a succession plan. It was only when God intervened did they come up with Tim Cook. But that was even on an interim basis because Steve was going to come back. One thinks that Steve might still come back, but that's another story. So when you look at who's in charge, you have to look at the three things. It's management, it's the board, and it's the shareholders. And one of the interesting developments we've seen over the last several years is the growth of what is called shareholder activism. I'll come back to that in a second. But the fact of the matter is, if you're looking at the board, you're looking at them for those three items, and then probably I will add something to that strategic plan because this became an important theme of shareholder activism. And for every budding entrepreneur, it should be your most important objective. And that is capital allocation. In other words, or in any words that you want to use here, how do you take the capital that's come to you from the investors or that you generate from your own business and your cash flow and allocate that capital to enhance shareholder value? There's that word again, two words, shareholder and value. So capital allocation is critical from a startup company to the largest companies in the world. Are you being efficient or inefficient with the use of capital? And that also brings us to what I want to talk about in two areas. Where are we effective in the use of capital? Basically speaking, in the 1950s and 60s, and I didn't graduate in the 50s, I did graduate in the 60s, but in the 1950s, the concept of capital allocation among American corporations was not even considered, or hardly even considered. So that companies got very, very fat They became bloated. They weren't looking at their cost of capital or how to use it effectively. When that happens, we start to see a transition occurring from the investment community. And if we look at shareholder activism today, it's so far different from what it was in the 60s and 70s. And then we had a wave, the first major wave of what I'm going to call hostile takeovers, which occurred in the 1970s, where some people were seeing that you could make more money on Wall Street than you can operating companies if you do things like bust up companies. A famous or infamous, depending how you look at it, investor, who was an operator at that time, called T. Boone Pickens, went after the oil industry. And Pickens used to say, I'll make more money drilling on Wall Street than I will in the patch. And he went after Gulf, he went after Unocal, he went after Phillips Peat, he went after them all. And I know because half the times I worked with him and half the times I worked against him. But he was on to something. He was on to something really big. And that was to go in and explain to Wall Street, if you support me in either my takeover attempt or in a proxy fight, which is a different situation altogether, I'll generate value for you. And that's exactly what he did. I remember I was at this time working for, my client was Gulf Oil Company, not the same Gulf you see today, which is not the same Gulf that was in Spindletop and one of the original, we're in the Rockefeller building, one of the original Seven Sisters of the oil industry. And I remember going to Pittsburgh every single week, going to Pittsburgh because we had a board meeting. And we would sit around in a boardroom, which, believe it or not, was just about this size for a company that big. It was maybe even a little smaller than this. And we were talking to the directors, and everyone would say, how can this guy even think about taking over Gulf? We are Gulf. We are the directors of Gulf Oil. He can't take us over. And the bankers and I and the lawyers would say, that's really not the way Wall Street works. Wall Street is going to be buying and selling your shares, and if he gets enough shares into people who support him, he's going to toss you people out. And it became a major proxy fight. And the irony is, it was not a proxy fight over replacing the board, which people tend to forget. Gulf at that time was incorporated in Pennsylvania, which is where they were headquartered. Most of American corporations are domiciled or incorporated in Delaware, because Delaware is a little more advanced in the law of business law. So what happened was, we spent more time talking to the board about what is going to happen. And the proxy fight, believe it or not, was whether or not Gulf should reincorporate from Pennsylvania to Delaware. And at the end of the day, with a very expensive proxy fight underway, proxies mean that you, as a shareholder, you get a vote. You vote your number of shares, and it's a plurality. It's not necessarily a majority. And Gulf, quote, won. They were able to reincorporate in Delaware. The sorry ending of the whole thing is that several months later, another company, Unocal, came in and made a tender offer and took over Gulf. But that's the way it goes. But I'm bringing this up for several reasons. When you think of activist shareholders, I'll bet, if you think about them at all, names like Carl Icahn, who is not going to be part of the Trump administration, at least not at 12:25 on a rainy day in Providence. You never know what's going to happen by 12:30. David Einhorn, Barry Rosenstein, relational partners. These are all of what we call traditional activist shareholders. They take a position in a company and then try to foment change. Some of that change will be on the area of strategic direction. What the company is doing right now is on the wrong path. It is not going to create shareholder value. So I will get a seat on the board or even take over the board by getting a majority of the board and change the strategic direction. One of the most popular issues in changing direction is busting up a company. This part of the company does this part does this. There are no, quote, synergies to make real value, so why not bust it up? And we have a lot of good anecdotal evidence where bust-ups really do create value. Because if the company is in many different areas, how are they going to allocate their capital to the growth areas or not allocate capital for areas that are generating a lot of cash and therefore can be self-generating? One of the arguments in corporate America is that if you have one that's generating the cash and the other is a user of cash, it makes sense for them to be married. One can fund the other. But from a shareholder's perspective, that's not right, because the marketplace will not give you full credit for that. So to create value, say some of these activists, bust up the company, and the high growth area will have a higher multiple on Wall Street, and the value will come up through stock appreciation, capital appreciation. For those other parts of the company, you will have a dividend-paying company, which may be very slow growth or even no growth, and you'll be able to fund your operations and also pay a nice dividend to shareholders. And it's a very popular concept, especially the way we are today, which is in a low-yielding environment. Where are you going to get oncoming stream of income? Treasury bills are too low. Corporate dividends are not very high, not compared to European corporations. So it's a compelling reason, and you will see almost every single day in every single argument that an activist shareholder will talk about is the concept of busting up a company. Carl Icahn did this very, very successfully in the 1980s, and I think that if you want to give oneself anecdotal evidence, is United States Steel Corporation, which used to be a really big, important corporation, had two businesses. They made steel, which they then sold to all kinds of places, including the automobile industry, and they also owned a major oil company. Were there any synergies there? No. They just acquired an oil company and they were the steel company. Carl Icahn said, that's really stupid. Let's bust up the company so that people who want to own a steel company can own U.S. Steel, and people who want to own an oil company will own the oil company. And if memory serves me correctly, I think that might have been Marathon Oil, but I'm not terribly sure about that, but that was it. So the bust-up concept has been a really important part of all of these activists. I think that even this week there was a concept of busting up General Motors. There's a concept of busting up IBM, because IBM has one as a services business on the cloud. And I mean, even companies like Apple are vulnerable to an activist shareholder. And by the way, in case you don't remember, they did have an activist shareholder shortly after Tim Cook took over. Remember who that activist shareholder was? Carl Icahn. And what did he say? He said, you guys are sitting on a hoard of cash. What are you going to do with all this cash? How much money do you need to come up with the next device? And Cook said, I don't know. And Carl said, so give the cash back to shareholders. Pay a dividend. Apple didn't want to go through a fight, looked at what its capital needs were, and lo and behold, started to pay a dividend. And I'm going to raise that for you to consider one other thing. Right now, when the government is looking at tax reform in Washington, and they're talking about various aspects of tax reform, reducing the corporate tax rate, maybe even reduce the individual tax rate, one of the biggest issues on the table right now is repatriation of income. By last count, and this is only about a week old, U.S. corporations have roughly $2 trillion of cash outside of the United States. In other words, when Johnson & Johnson or United Technologies or Boeing earns the money overseas, it becomes tax inefficient for them to bring it back. They're taxed overseas, and to bring the money back, they will be taxed again. So these companies have kept the money in their accounts overseas. So think about this. $2 trillion of cash, not operations now, cash, sitting outside of the United States by U.S. corporations. If, and it's an if, but it might be bipartisan at this time, if the tax code is changed and companies can repatriate that cash, and all of a sudden that money comes back into the coffers, back into the U.S. domiciled headquarters, what are they going to do with the cash? What? Invest in what? New enterprises. Okay, you entrepreneurs, go line up next to Johnson & Johnson and Boeing. They're going to have a lot of cash. My bet, and it's only a bet, is that if companies aren't starting to think about the prospect of having a windfall, someone else will. And who will that someone else be? An activist shareholder. All of a sudden, Johnson & Johnson, I just use them as an example because anecdotally I'll tell you something. Johnson & Johnson's going to have several billions of dollars coming back. How are they going to invest it? They're going to make better Band-Aids? Maybe. But they've got enough cash right now in the United States to do that. Are they going to buy a company? Possibly. Are they going to build more plants? Possibly. You just don't know. So what they did 2 months ago, or actually it's about 4 months ago, they bought a Swiss company, a startup Swiss company that's in the, I think it's in the vaccines business. I'm not sure what it is. It's a good company. And what did they use to do that? Cash that was sitting there. So rather than wait for the cash to come back here to buy it there, they used cash already there. They can't know when Congress is going to change or ever change the tax laws, but they're already starting to think that way. I will tell you this right now. Companies in that situation that are going to have a windfall of major cash coming back, if they do not have a plan, part of their strategic plan for what are you going to do with this money coming back, somebody else will. So when we think about activist shareholders, and I mentioned guys like Carl Icahn, who is really one of the original of this generation of activist shareholders, Barry Rosenstein, and I think he gave a talk about a year ago in one of the classes in the economics department. Barry Rosenstein, David Einhorn, and until last week we could have said Bill Ackman, but I think he's hiding under a rock someplace after his investment in Valiant went so far south. But who else are the activist shareholders? Well, you may or may not be surprised, and I brought this book, which came out a while ago, Dear Chairman, and I want to just read you something. This is a sentence. The determination of whether capital not needed in a business is to remain there or be withdrawn should be made in the first instance by the owners of the capital rather than those who are administering same. Accordingly, the undersigned, as substantial stockholders themselves and speaking on behalf of many others, urgently request that an opportunity be given them to discuss the situation with representatives of the company to the end that a comprehensive plan may be devised to remedy the present unsatisfactory situation and to improve the position of all the shareholders. Sounds pretty activist to me. It was written by a guy named Benjamin Graham. And that Benjamin Graham is, as we should know, the father of modern security analysis. You know to whom that was written? What building are you in? He wrote this to Mr. John D. Rockefeller, Jr. So we don't look at Ben Graham as an activist shareholder or his student. Anybody know who one of Ben's students was? Come on, who's the best investor in the United States? Thank you. Warren Buffett was his student. And Warren is an activist shareholder. He doesn't wait for things to happen. He goes out and foments it. And Warren wrote a letter to Mr. Howard Clark. At that time, this was in 1964, June 16, just about when I graduated from this place, and of the American Express Company. And he ends the letter by saying, "These must be trying days for you and the rest of management. Let me assure you that the great majority of stockholders, although perhaps not the most vocal ones, think you have done an outstanding job of keeping the ship on an even keel and moving steam ahead while being buffeted by a typhoon which largely falls in the act of God category. That typhoon will pass, and I think history will show that the ship has continued to make great progress." Warren Buffett is a great investor. He's also an activist investor. And I think that it's fair to say that in corporate governance, be you an entrepreneur or be you the head of Standard Oil Company of New Jersey, or be you the head of the American Express Company, as this one was, or be you the head of almost any company, it is your role as an entrepreneur to protect the capital of your investors. That is your job. I saw something early this year. I took it out of the Financial Times. It was in January 28. And if you look at who the biggest asset management companies are in the United States, the largest one by far is a company called BlackRock in New York City. It's run by Larry Fink, and they've done an outstanding job. Although today, ironically, they don't call themselves an asset management company. They call themselves a financial services and technology company. And they do that because they are now using very sophisticated technology to generate returns for their shareholders. And there was an article just about a week ago where BlackRock announced that they were going to lay off a number of their portfolio managers and replace them by bots, robots. They will be making your buy-sell decisions. And he's recanted that somewhat by saying, well, we're not replacing human beings. We're just getting a little more help. But a lot of the trading will not be done by human beings. They will be computer-generated trading. So the headline read, and this is January of this year, BlackRock, Vanguard, and State Street bulk up governance staff. They are going to be expanding the policies and policing the companies they invest in. So understand that companies like BlackRock, Vanguard, I could throw in Fidelity, probably, and State Street, which manages and operates a great number of mutual funds as well as cash management businesses, they're taking overhead to expand their governance staffs. There's a reason for doing this. The reason is U.S. corporations, and I say U.S. corporations because for a great extent, this is not the way it is in every country. It's certainly not the way it is in Japan, and certainly not the way it is in a lot of other countries where governance is not as sophisticated or as transparent as it is in the United States. And one of the reasons I personally believe that is the way it's done is because shareholder activism is not as endemic as it is here. So I want to do a couple of things before I show you one of my greatest failures and lessons that I've learned over the past few years. What do activists do? How do they get the attention of management and directors? Generally, it's a letter writing campaign, and that's, it started with guys like Benjamin Graham and Warren Buffett. But today's letter writers, be it the David Einhorns or the Carl Icahns, are very vocal about what they are going to propose to management, and they use the media and the social media to get their ideas out. They can actually take on managements and boards by proxy contests. And one of the interesting things is that when we think about proxy contests, we sometimes look at it as this slate is going to run against the incumbent slate, and they're going to take over the management of a board. That's not the way it works. That's a hard election. They would do something else, something we call a short slate. So if there are 11 seats on the board, these activists will say, we'll run 2 candidates. And with cumulative voting, which has now become, you can accumulate all your shares and vote it in 1 or 2 persons instead of spreading it out among all of the candidates. With 1 or 2 activists on the board, the dynamics in the boardroom will change. They will become more focused on generating shareholder value. What are the things that that board will do and the activists want to do? As I said, there are the situation of the board. Number 1, strategic plan. Number 2, personnel. If management's not doing the job, put a new group in. Strategic direction. How many times have you read that a company is doing some kind of a strategic review of its business? That is code for maybe we're going to sell the company. I will promise you this, if you read in the Wall Street Journal that XYZ Corporation is undergoing a strategic review, that stock's going to go up between 5 and 10% the next day. It may not hold that price, but everybody on Wall Street is saying, the company is for sale, which may not be true, but it does mean that they are studying spin-offs, bust-ups, if you will, sale of assets, sale of the company. That's what a strategic review is. Who else is an activist in this world of entrepreneurialism? Well, they're the ones we pay for, theoretically. The regulatory bodies, the SEC, state regulatory bodies. They are there to make sure that managements and the boards are not derelict in their duty. And they are, to some extent, marginally effective. Not nearly as effective as an activist shareholder. They don't have the capabilities. They probably don't even have enough skin in the game. But that's another issue as it relates to it. But as a budding entrepreneur, you are probably going to be more concerned about the regulatory bodies than you will about your angel investors or your venture capitalist investors, because they're the ones that you eventually have to report to. And in case you don't remember it, when companies such as, and I won't use Apple again, let Steve, I don't want him to spin in whatever grave he may be in, but when Google got started, they put an adult in the room, Eric Schmidt, who's been around the block a couple of times because Larry and Sergey were out doing their thing, but who was going to keep that ship on an even keel? It was Eric. And Facebook really didn't get started and follow a strategic plan until Sheryl Sandberg came on board. And I mean, you know, Mark is doing his thing, God bless him, he's doing it well. But the adult in the room was Cheryl, who would say that. Steve Jobs did not have an adult in the room. And I will tell you this from experience, because several of my friends have been directors there. And I remember calling this director friend of mine. I said, by the way, you know, Steve is battling cancer. This is his first bout with cancer. I said, what is the board doing in terms of succession planning? And he said something that just blew me away. This is a sophisticated director, the CEO of his own company. He said, I have no idea. I said, but you're a director of the company. How do you have no idea? He said, Steve will not let us put it on the agenda. There you go. And Steve never put it on the agenda until he was far gone. Liz, I'm going to need your help for something. A couple of years ago, and I put this on anecdotally, a couple of years ago, I learned a very, very painful lesson. In 2013, there was a family feud, and this a family feud, you want me to try this? Yeah. Of a supermarket chain in the Boston area, but it also feeds into, I think, New Hampshire and a couple of places. It's a very successful supermarket chain called Market Basket. Liz, which one do I push? Anything? Right, the right one. Okay. Oh. Not the right one, Liz. Come, help me. We were hired. Oh, sure, I knew that. And I'm using a timeline of May 2013, September. And it was run by the Demoulas family, a second generation Greek American family that ran this supermarket company. Here was the overview. It's a privately held company for all you entrepreneurs with stagnating profits, but it was the leading grocery chain in New England, and it ran a very, very good business. It had an extremely loyal shareholder, associate and customer base. They worked on a more for your dollar, committed to low prices, generous compensation, and profit-sharing plan for the employees. But it was a long and tumultuous family history of litigation and who owns what. There was a 7-member board. 2 directors represented the so-called A shareholders, which was one part of the family. 2 directors represented the other part of the family, so there was absolute stalemate there. And there were 3 independent directors. Why can I call them independent directors? Because the courts adjudicated that these 3 people were independent. So for all intents and purposes, 3 directors were running the company. You had one author who was the CEO, but under a court order, there was a newly elected board which was structured this way to implement best-in-class corporate governance practices. Also sought to protect shareholder value by seeking answers on a number of issues from management, from Arthur T. Demoulas, including questionable real estate transactions. You're a supermarket company. You build boxes. What happens if the box you're building happens to be on the land owned by your wife and the contractor happens to be her brother? There could be a conflict of interest. And without any oversight, they could do what they want. Arthur had Arthur T, and I'm going to say that because the other cousin, ironically, was Arthur S. So no care whatever for improved governance. All right, I'll get this right. There's a quick timeline. Board was reconstituted the way I said it. There was all of this happens with fights going on. Now, what is not seen here, by the way, in one of the questions in August of 2013, a distribution was made to shareholders. There were 3 shareholders. There was Arthur T, Arthur S, and a sister. That was it. Entrepreneurial company. And when I'm not talking about, you know, a dollar or two, I'm talking about hundreds of millions of dollars of distribution to these three people. Then in January, Arthur wakes up on Christmas morning, Arthur T, the CEO, wakes up on Christmas morning and decides to maintain market share against the Whole Foods and Hannaford's and whoever else is in the area. I'm going to give a 4% discount to all of my, across the board to all of my customers. Maintain market share. Killed their margins, which in the supermarket business isn't too much to begin with. Finally, the board decides in June, 6 months later, not to re-elect Arthur T as the CEO. There were too many governance issues involving conflict of interest, etc. So what they do is they don't fire him. That's important to remember, because you'll see how social media turns things around. They don't fire him. What they chose to do is not renew his contract. So they bring in two managers. Jim Gooch and Thornton come in as co-CEOs. The employees go crazy. They walked off their jobs. They had a boycott. The company is close to going under. They bring in and Arthur T, the CEO, who no longer is CEO because Thornton and Gooch are the CEOs, says this can't go on, but he's encouraging through social media a major campaign from employees to continue to put pressure, to the point where Governors Patrick and Hassan begin public comment on this. So did senators from the various areas, because the whole thing was played in the mainstream media of man bites dog. Where do you see employees coming to the defense of management? It played out all over the place. It played out locally in New England and on the national news. It must have been a slow news year. Here was the communications challenge of the board. We had to tell the people that the fight was all over corporate governance. Do you know how exciting that is when you have hundreds of people walking the picket line and not doing it? You can't win that kind of a war. And quite frankly, we were clobbered. They set up a website. They had petitions. They had large-scale protests. They retained a local political firm in Boston. They took out full-page ads. They did a letter-writing campaign. They had a Facebook page. They were fantastic. They were beating the crap out of me and my team. There was no doubt about it. Our boss and only boss, We Are Market Basket. It was unbelievable. What did I have to work with? Corporate governance. Anybody care about corporate governance? You tell that to the nightly news. They don't care about corporate. They don't know what it is. So we had to tell, this is the role of directors, this is the role of management, this is the board, their responsibilities. Forget it. I'm getting my head creamed every single day. The media coverage was unbelievable. You had a Family Feud, you had the whole thing going. Here was Arthur T, always looking, taking care of his people. At the very end, we knew how this was going to end. We knew that somehow somebody had to come along and take out the whole thing, get rid of the shareholders, buy them out, and move on. And that's exactly what happened. We could have predicted this. We did predict it from day one. What happened is that the board decided this stalemate's not going to end. So they did a strategic review. And what they did was say, we're going to sell this company because the family can never operate it together. So they went and did a strategic review. They looked at so-called strategic buyers, which would be those people already in the business. And basically, these were supermarket companies. And the three that they looked at actually came from Europe. And two are very big companies with operations in the United States. But there were also three private equity firms looking at it. Because while they don't make a lot of money as a supermarket, unless you used to be Whole Foods and they're not making that much money anymore, you have incredible cash flow. So if you're a private equity company, you can pile on debt, and the cash flow you're going to generate will pay the debt, and you still end up with a good asset. Remember what I said at the beginning. Nobody questioned Arthur T. DeMoulas as a bad operator of the business. Quite the contrary. He's a fantastic operator of the business. What the question was related to his ethics and the governance issue. At the very end, the national media started to look at this from a different perspective. Holman Jenkins of the Wall Street Journal wrote 3 editorials and called this the market basket fairy tale. Forbes said, you could just read this thing, but the game was over. My point on this was, very simply, I got my head handed to me. I learned a lesson, and something that I can use in politics today if I ever run back into politics. Number 1, don't discount the power of the social media. No, I don't know how to tweet, and I certainly don't know how to tweet at 3 a.m. in the morning. Don't discount it. It is powerful. It's a powerful means of communication. And the second thing is, well, I believe, and I hope you will believe too, when you start your own businesses, that you will pay attention to what those things are, that you owe your investors something. That's the governance here, that you keep your promises you make to your investors. They are your partners. They're the ones who own your business along with you. So God help you, be successful, be entrepreneurial, but get an adult in the room. Thank you. We have a couple of minutes if anybody has any comments or questions, and I try to answer them, whatever. Otherwise, I'm going to be hanging around for a little while longer, according to Liz. Yes?
Yes, you mentioned that companies must protect the capital of their investors, but how do you justify this in the context of rising economic inequality? Because you're saying these companies are sitting on $2 trillion. These companies are sitting on $2 trillion.
That are going to be coming back.
That'll be coming back.
One would think.
To avoid double taxation.
Correct.
But shouldn't this be taxed?
Well, you've already paid the tax on it. That's why it's still overseas. You've paid it when you earned it overseas. So it's punitive for you to bring the money back. That's why you haven't brought it back. I think that what will happen, I hope this will happen, because it will create greater capital infusion in the United States, which will lead to growth in jobs. If the new tax bill, whatever it comes out, will forgive those or get rid of those taxes, they can bring the money back without being taxed again when it comes into the United States. So then Johnson & Johnson or whomever it is going to have this windfall. And maybe they will invest in startup companies, and I think they will. They will put money into biotech. They will put money into different things. Money that is sitting overseas. Don't I sound like Trump? God help me, I don't. But money that's sitting overseas and being invested overseas because of the taxation to bring it back. Yes, David.
Following up on that, so sort of the doctrine you wrote here, the view that corporate governance is about the responsibility of management to shareholders, is consistent with a lot of law and economic analysis over the last several decades. But it's not the only view, right? I mean, there was a view that, or there is a view that there are other stakeholders, workers, customers,
exactly,
people in the environment,
exactly,
folks like that. And indeed, when people talk about sort of rising inequality over the last several decades, one of the views has been that what's happened is these other stakeholders, in particular workers, have kind of been pushed aside by activist shareholders, by your friend Pickens and Icahn and people like that. And then sort of the result of that has been this I don't want to say misallocation, because I'm not trying to make an ethical claim one way or the other, but that's been a big contributor to rising inequality. Are you sympathetic to that view?
I am, actually. And here's the irony. When I said earlier that 90% of American corporations are incorporated in Delaware, Delaware law, excuse me, is not sympathetic to that. And that's the problem. The interesting thing about the DeMoulas case was he used the argument of stakeholder value, because his stakeholders were his employees and his customers. But that didn't hold up even in Massachusetts court, because they would follow the business rule of the Commonwealth of Massachusetts. And under Delaware law, a great deal of levity is given to the directors. They are virtually bulletproof. So when you go in and argue stakeholder rights, employees, customers, vendors, it doesn't count. When you go into the litigation in Chancery Court in Delaware, you can lose. Which is not surprising why so many companies are incorporated in Delaware. I frankly do believe that stakeholder rights take an important place. And from my own experience, when my partner and I formed this company in 1971, we cared very much about stakeholders. Yeah, we had all of the shares basically, but what we decided to do was make sure that all of our associates and eventual partners also shared in it. But we could do it because we were a small entrepreneurial company. But the DNA was started then. Then when we sold out to a big French conglomerate in 2008, the game changed. A, they were French, and B, they were public. So they only cared about what they can take out of it. It was a wrenching moment for us, but we also recognized if we wanted to institutionalize the firm after we either departed from the firm one way or the other, there would be some kind of a framework that remained. But I have defended a lot of companies on the stakeholder rights thing. I think one of the most important decisions I ever made, we worked for a company called Dayton Hudson Corporation out of Minneapolis, which you now know today as Target, or Target if you really want to play the game. And it was in the crosshairs of of a activist strategic buyer called the Haft family of Baltimore, Maryland. And they wanted to take over Dayton Hudson and split it up. There was a department store, the Gold Line, the Dayton's department store of Minneapolis, and the Hudson's of Detroit, and grow this entity called Target. And the company fought it furiously to the point where we were able to change Minnesota law. It was domiciled in Minnesota and headquartered there. Change Minnesota law on a short-term basis, which virtually prohibited the Hafts from taking it over. What was the basis that we used? Two things. Number one, the company gave 5% of its pre-tax profits to charity. If you earned 5% in Rhode Island, 5% went back into Rhode Island charities. The second thing is they had something that they sold at the Dayton's department store called Santa Bear. We would do ads showing this little Santa Bear and saying, protect this endangered species. Well, it's ridiculous. We look at it today and say, did we really do that? We really did. And the state legislature, and this is in the summer, and they're all out hunting and fishing and killing mosquitoes or whatever they do in Minnesota in the summer. And what they did do is pass this bloody law. And the Hafts went away, and Dayton Hudson survived, and today that's the Target Corporation. But we did it on the basis of stakeholders. Who really does it? If we were a Delaware corporation, we would have been toast. But you're absolutely right. I do believe in stakeholders, and that's an example of defending it. Yes, sir.
As a business owner, like looking over maybe like 10 or 20 years of future growth, ideally, what prevents you? What are some incentives to not incorporate in Delaware or not IPO with non-controlling stock?
Well, as long as you have 51% of the stock, I don't care where you incorporate.
Yeah.
Okay? So be careful of how much stock you sell at that time or give away as a budding thing. But if you have controlling shares, you can incorporate wherever you want. Because at the end of the day, you're going to control the board. I don't know what the answer would be except maintain control. Luckily, when we decided to sell our company between my partner and I, we had 65% of the stock. Even though we had 65% of the stock, we wanted to make sure that the other 35 went along with us. And we did. So that everybody at the end of the day was treated equally. We had opportunities to sell it at a higher price if we only sold our control shares. But we didn't think that was ethical, so we didn't do it. If you're a public company or going to be public, right now, incorporate in Delaware. If you have 51%, incorporate wherever you want, whichever most convenient. By the way, reincorporation was also a fad that went on. I remember when we were working for the Gap, which in those days was known as the Gap stores, they were incorporated in California because that's where they started. But when they wanted to expand and make acquisitions such as Banana Republic or open up a new venture like Old Navy, you're not going to get a payoff right away. And Banana Republic was not what you see today. It was a mail order company. And they really tried to buy Land's End, but they couldn't buy Land's End, which was a private company they didn't want to sell. So they they bought this little company called Banana Republic for mail order. Now, of course, mail order is dead because online does it all. But they have bricks and mortar, which is probably, hurting their bottom line, but that's another. But they reincorporated in Delaware to do this, just for that reason, to give the directors the blanket protection that incorporation in Delaware can bring you. Go ahead.
So there's this, I can't remember where I heard it from, but there's some quote which is like, nothing in Washington, no fight in Washington is ever over, right?
Yes.
And so I would assume with like a lot of activist shareholders in the general ecosystem, why aren't they investing in a legal fund to change Delaware law?
Oh, I think you might have stumped me there. Why wouldn't? Because it also works in their favor. Now, what's happened over the last few years with the SEC and with Delaware, they have started to swing more in where the shareholder rights, not stakeholder rights, but shareholder rights are going. So it's very interesting because there's a proxy advisory firm known as ISS, Institutional Shareholder Services. And over the last several years, they would support and bring their weight to the activists. Because the customers of ISS, and let's assume for the moment that you are a state pension fund, okay? You run Rhode Island's pension fund. You, to avoid any conflicts, you virtually had to vote the way ISS told you to vote. So ISS went a lot towards the activists because they said over a period of time, it demonstrates that their presence has increased shareholder value. 2 weeks ago, ISS flipped and said, we're going to be more neutral, and to support an activist position, they really have to demonstrate more than what they were going to say to create shareholder value. An interesting change. We're not into proxy solicitation season yet. Proxies are just going out now for April, May, June meetings. But it will be interesting to see what activists come up and how ISS has really changed. But remember, that was their strength. They would always go with a short slate because they're going to say, it's probably good to have a little roiling in the boardroom because the other one was getting too fat, lazy, and rubber stamping management. But be interesting to see.
Thanks.
50% ownership, 51% ownership, and go wherever you want. Otherwise, go to Delaware. Yes?
Do you think Snapchat is overvalued?
I don't know. Jim Cramer does, and I listen to Jim Cramer a lot. I don't know. I don't know enough of their business model to say what is unique about it. So Do I think that someone like Facebook can come in tomorrow and wipe them out?
They're actually
Possibly.
trying their best, you know, like I feel that Facebook is trying their best to wipe them out, and they.
I won't bet against Facebook. I might bet against Snapchat. And when it came up, Jim Cramer on CNBC said, it's overvalued. He said he picked exactly within this close what the closing valuation on that stock would be on day one. And by God, he hit it. The stock has come down a bit. It's gone back up. I just don't know whether or not its business model is so unique that A, can't be copied, or B, can't be taken over. Somebody else like Facebook could come in there. I just don't know enough. I won't buy the stock, though. I'll buy Johnson & Johnson, though. Yes.
Do you prescribe to the ESG argument that a set of like governance metrics can be applied to stock market at large to predict outperformance? And if you do, what metrics, in your experience, would you say are the most material to drive value?
That's a great question. And let me go back to one of my favorite companies, which is Amazon. For many years, the popular metric has always been earnings per share, and as a multiple of your earnings per share. Then a guy named Steve Ross came along in the 1980s when he was building cable systems at Warner Communications, and he said, earnings per share doesn't mean a thing. What you really have to look at are two things. One is EBITDA, because we have a great deal of interest expense when we build out all of our cable systems, and cash flow. So look at the cash flow generation as opposed to EPS. And you know, when you're a growth company, you're not going to have EPS because you're not going to have E's. You're going to have PS, but no E. So what's a better metric? And I remember when Amazon did a deal with one of my clients, and one of my clients was a traditional retailer, and it was being valued on EPS. And we were doing this joint venture with Amazon. And the people from Amazon's communications company and their internal came in to meet with us. And my client was talking about the accretion from this partnership on our EPS. And they went, oh, you can't use that word. And I said, what word did I use? Earnings per share. Why can't I use earnings per share? We're not allowed to use the word earnings at Amazon. Amazon didn't have any earnings per share because they were growing so rapidly. They showed you another metric, customer count, which is something else that Steve would do with his cables. You don't have to evaluate earnings. I don't have earnings. I'm in an investing mode, and I'm using all of my earnings. So look at my EBITDA, get rid of my interest. You know, it's before all of that. You know what EBITDA is? Earnings before interest and depreciation and amortization. So don't look at it from that perspective. I don't know the answer because every so often you invent your own metric. I'll tell you the one thing I did in my business years ago. In 1975, before everybody was born here, including Danny, in 1975, I wrote a monograph with a partner of mine called The Capital Markets and Corporate Communications. And my partner and I came up with the idea that in May 1 of 1975, Wall Street moved from what was called from fixed commissions on stock transactions. Whatever stock you bought, one stock or 100, there was a fixed commission. That commission enabled the brokers or the sell side to give you other services, basically research, but other services as well. On May 1, 1975, something that was called May Day, negotiated commissions came in. It wasn't fixed anymore. So we said, maybe we were smart at those days, entrepreneurs that we were. What is the impact on this on the corporations? You no longer had Merrill Lynch going out and selling your stock because Merrill Lynch got its commission no matter what. And if they stopped getting, if they're going to start to lay off the analysts who were following that company because they had to save money because they weren't earning their keep anymore, it was up to the corporations themselves to demonstrate to the investor what its plans were. Hence, from my perspective, it was a growth of corporate communications, or as we called it, financial public relations. We found a market niche, and we made a lot of money doing that, which was luck. But we were also entrepreneurial and figured, hey, let's do it. If we made a mistake in 1975, is that we underestimated how important that event, May Day, was. And it changed the paradigm. So what happened is a lot of those brokers, sell-side people, moved to the buy side. So Fidelity, which had portfolio managers but no research capability, took those people from Wall Street and brought them to Boston, and they did their own internal research, because Fidelity would then call up Merrill Lynch to negotiate the transaction cost, and they got it down to this. Those are smart money, guys, but that's what happens. Yes?
So it's clear that there are many benefits to shareholder activism. Are there any cases where shareholder activism fails to increase efficiency within a company and generate value? And if so, are there any actions that entrepreneurs can take to fight against a rogue activist shareholder?
Great question. There is an ongoing debate, ongoing even till today, with two major players. One is a guy named Marty Lipton, who was a named partner of Wachtell, Lipton, Rosen and Katz, one of the biggest takeover law firms in the country. And Marty Lipton has been on the, and I'll say the word, jihad, that activist shareholders do not create value. Guess who his clients are? Corporate America, basically his clients. On the other side of the coin is a guy named Lucian Bebchuk. Lucian Bebchuk is a professor at the Harvard Law School. He has railed for a number of years that activist shareholders are in fact important at creating value. Boom. Boom. Always arguing, always the same argument. My own view, which is personal, because I don't want to piss Marty off, and I don't know Lucian, but Marty does send business our way from time to time, is that I believe that activist shareholders, including guys like Larry Fink at BlackRock or John Bogle at Vanguard or Warren Buffett, or that do create value. Because it does, yes, because it does make managements stop and think, and the board to stop and think, what else can we do? Most managements do not necessarily go out of their way to think out of the box. This is the business we have. I had a client who once, big company, and he said, I said, well, how do you see your job? And he said, I look at myself as a pilot of a 747, and my job is not to crash into a mountain. That's not a growth prospect for me. I don't want you to crash into a mountain, but I want to figure out what other things you can do to create value. If what you're going to do, he looked at himself as a steward of the company, not necessarily the steward of the shareholders. And if I were a director, I would have kicked his butt out, because your job is to create shareholder value. Okay?